I'm going to start the recording. All right. So where were we? We were here. Okay, we are now looking at the, we have the technical note. We are also looking at the case. We have gone up to key risk factors, hedge transaction, hedge position. And now we are trying to look at the case. Right, so it takes us to the oh yeah, we took it this way. Okay, fine. Right. So this is where we are. We are in the figure one, and we are just looking at the where we left off the other day was we were looking at how the yeah. So I've just created a copy here where I can make edits. You can see the changes, and so we have right. So you're looking at this. Now, what I was telling you the other day was the way in which you manage the currency exposure is. Let's open up the charts. So what we were telling you is how to manage the yen exposure. In general, as in currencies, because the most important, the primary market for price discovery in foreign exchange is the spot market, which is a very liquid market, $5.1 trillion in the last survey. And therefore, what you have to do is you always have to track the most liquid market, the primary market for price discovery, the market instrument combination. So for foreign exchange, you don't track futures in terms of looking at the charts and stuff to form your views. You track the spot market. And with the spot market, the convention is, and these are matters of convention, the spot market, but you have to know those conventions as well. Like India driving on the left-hand side of the road is a convention. It's not there's nothing conceptual about it. But it's just a convention that you need to know. So now here, when you look at the spot market convention, the convention is to quote the dollar as the base currency. But when you get into futures, the convention is to quote the futures as in the case of futures, the convention is to quote the yen as the base currency. Okay, so the number of dollars for 1 yen. That is what you have to look at. So that's why the yen prices, they look kind of funny. So when you have to, the way you'll have to manage this is a little nuance that you learn from basically teaching you how to actually manage risk. These are some of the complications. So the prices are very funny for Japanese yen futures. These are currency futures, okay? You have some of these trading on the NSE as well, but the liquidity is very poor in India because we don't have capital account convertibility. So there are all kinds of restrictions. So whenever you put restrictions, that you should understand, because this is a major problem in the regulatory approach in India. As Indian citizens, you have to understand this, that the more restrictions you put on a market, the less the liquidity is going to be, because you're shutting out all kinds of players out of fear that they will engage in speculative activity. But you're missing the point that speculation brings liquidity to the market. It's a major problem in India, which is I think one of the major reasons why we are not developed. We are not a stronger economy than we can be. So anyway, we have these currency futures in India as well, but these are the most liquid currency futures contracts actually on the CME that you have. But nevertheless, these are not the major markets for price discovery in the case of as Vipul was mentioning the other day, the exchange rate between the dollar and the yen. Okay, this is not where the exchange rate for the dollar and the yen is discovered, or most important place for setting that price. This is the currency futures market. That is not set in the futures market. The most important market is actually the spot market, which I showed you the other day, trading in Net Danya. Okay, so I showed you the Net Danya majors, right? Forex majors. So that's the spot market quotation, and you can see that spot market quotation, which is basically giving you the result that you see, right? So I'm just waiting for the Net Danya to open up. The other thing you'll notice in the difference is, if you look at the spot prices, remember these are actually futures prices, okay? These are futures prices, so you notice that there are multiple prices. So one of the difference between forward prices and futures prices is, spot prices and futures prices is, in the case of spot, there's only one price, okay? Typically, when you look at the spot price, there's only one price because it's the price that is trading for T+2 delivery. That's the price that you're looking at for spot. So there's only one price. Whereas in the case of futures, as you will notice even in the case of the crude oil futures, there are different prices for different maturities. Okay, this is true of forwards as well. So one of the things you'll have to make up your mind on is, in fact, what you do is if you look at the actual spot price, you can experiment there. In the case of the dollar yen, there may not be a huge difference, but if you look at the spot price, because this is for a T+2 delivery, okay? So this delivery price, the spot price, if you just invert the price, you will not get the exact, if you just do, suppose the price here is whatever it is, okay? I don't know what the price is right now. I mean, one or something, let's look at it. Closing is 103.73.6. 103.73.6. So if you invert 103.73.6, whatever you get, something close to this, but not exactly this. Okay, because this maturity is a different date from the maturity date that you have in the case of the spot contract. So it's Feb 2021. You have to look at the contract specs and find out what is the settlement date. You have to look at the contract specifications, find out what the settlement date is. So it's a different price. So that's why this price will not be the exact inverse of this price. So it's 103.74. It's showing you the price here. So the point I'm trying to make is, because you have to remember that any settlement date, whenever you change the settlement date, the prices will differ. You can already see this here when you looked at this. Now these are, so I'll show you once again from the, let me see if Netanya has futures prices. They don't have futures prices, okay, fine. Okay, so let's try and look at the bar chart futures again. Let's try and call it up if we can. Okay, so the point you'll understand is that obviously that whenever you're looking at a futures curve, this is called a futures curve. This is not very active because in the case of financial futures like currencies and stock index futures, most of the volume is in the first 2 months, and you don't have too much volume out front. Okay, that is the tendency, that is the characteristic of financial futures contract. But if you're looking at commodities, you will see all kinds of volume distribution across the curve, because there are many producers and consumers who are playing in this market because they need to buy the underlying commodity. So they are placing orders in the far out months. Whereas here, the futures market is not the most liquid. Most of the activity in forward maturities is done through the forward market, not the futures market, in the case of currencies. So you have to know all these little quirks, right? So the basic principle that one of the things you should understand is that you notice this. Now we're looking at the crude oil futures, okay? Now notice again that for different maturities, the prices are changing, okay? So if we blow it up a little bit, maybe, you can see the prices up. You can see the prices now, prices 39 here, 37, small changes, 24.05. Now you see slightly bigger changes, 05, 5278, May to June. So why are these prices different? Now the commodity is the same. The base asset is the same, the terms asset is the same, and the instrument is also the same. They are all futures, okay? Now the reason is very similar to the reason that you would have found in the case of options. Okay, in the case of options too, you would have had, in the case of options also, you would have noticed everything else remaining the same. If you change the maturity, the price of the option changes. So similarly here, the general principle that we draw from this, or on which this is based also, is that if you change the maturity date of a particular contract, then the price is likely to change. It's not true that, I mean, it is not necessary that it'll always be is always going to be different, because if interest rates are the same, it may end up being the same. So therefore, our interest rates are zero, sorry, not the same, but interest rates are zero, then the prices will be the same, because there's no time value of money. But generally, when the maturities are different, the prices will be different. Okay, so you have to notice that. So going back to what we looked at, you will have to make up your mind as to which particular contract. Here you'll notice that the volume is greater in the March contract. So you should use the March contract to hedge. But as to how you will hedge, whether you'll be putting on a short hedge or a long hedge, that part you should decide after you form your view. Okay, short and long is clear from the underlying position, but as to when you will hedge, when you will put on the hedge, that will be decided by looking at the spot charts. So all the market analysis in the case of currency should be done by looking at spot charts, because this is where the main action is. Okay, in general for everything actually, because spot charts you don't have the discontinuities that you have with futures charts. So it is always better to look at spot charts for market view, forming your market view, and then the market view will decide when you actually hedge. Okay, so that's the thing. So the point I'm trying to make from the previous class is an important point, that in the dollar yen, you will face a problem, because you will have to do your analysis based on spot, where the dollar is the base currency. And then when you come to hedge, you will be hedging in the futures markets, currency futures, where the yen is the base currency. So it's pretty much approximately the inverse of what you see here, approximately, but slight difference because of the differences in maturity. This is March 2021, and you can look at the contract specs and see. I'll give you this exercise. This is what you have to do. So part of the reason for, part of the objective of doing all these course projects is for you to understand these important contracts, and also learn how to analyze any particular futures contract. When you're looking at a futures contract, what are the things you should look at? Okay, so here you can find out, if you want to know what is the maturity date, you can see here that this is the contract size. Okay, so exchange traded market, therefore very standardized contract terms. Every contract is this many Japanese yen. Okay, and the base currency is Japanese yen. Now look at settlement method, termination of trading. Yeah, you see this? Trading terminates 9:16 Central, CT Central Time. Central Time means it's Chicago, 1 hour behind New York, okay, which is Eastern Standard Time. So referred to as ET or EST. Okay, on the second business day prior to the third Wednesday of the contract month. Okay, so the way you do that is second business day prior to the third Wednesday of the contract month. So this is, let's say March. We're looking at March, second business day prior to the third Wednesday. You call up the March calendar. Third Wednesday is first Wednesday, second Wednesday. Yes. Okay. I can't. Is there a problem? Are you guys facing a problem? Okay. All right. So let's continue. So what do you do? How do you figure out what the maturity date of the March contract is? Go here. What does it say? Trading terminates second business day prior to the third Wednesday of the contract month. So if the contract month is March, go to March, first Wednesday, second Wednesday, third Wednesday. Then second business day prior to that. Tuesday is a business day, Monday is a business day. So therefore, it will terminate on 15th March. You have to make sure that these two are not holidays in the US. There might be some holiday. You have to check that. Okay, the US has very few holidays in general compared to countries like Japan and India. But still, you have to check that this is not a holiday in the US. So I'm assuming these are not holidays. So in this case, the trading will terminate on 15th, okay, at 9:16 a.m. Central Time, the Chicago time on the 15th of Monday morning. Okay, so you might as well, to be on the safe side, close out any positions in the March contract, you should really close out on the 12th. Okay, so when you're trading any contract, you should have to keep an eye on all these things, especially for futures contracts. So you should have a plan as to, okay, you have a marker that, okay, in this, if I'm trading a March contract, I better get out by the 12th if I have a position. And then you have to roll it over to the next contract month. Okay, if you still need a position. So this is also something else that you will learn in this project. Hopefully we have enough. We are so short of time, but hopefully we have enough time to trade for you to understand rollovers. Okay, what you have to do is you need the hedge. All right, now you can see some new contracts new prices are coming on. So two contracts have traded. Okay, because this activity is starting. All right, now what will happen? Suppose March. Okay, we looked at March. Now, here somebody's voice is still coming through. I need to make sure that, just make sure, guys, just please everybody check that you're on mute. Okay, some voice was coming through just now. Okay, all right, so notice that, okay, so volume is starting to pick up. Now what happens is, if the March maturity comes in, okay, and you still need the hedge, but the March is going to mature, the contract is maturing on the 15th of March, and to be on the safe side, 15th is a Monday, early morning. You want to be safe and you want to close it out before that on 12th Friday itself. But you still need a hedge. It's just that you can't have it in the March contract anymore because the March contract is closing. So what you have to do, suppose you had a short hedge. Okay, suppose you had a short hedge. Just giving an example. What you'll have to do is you'll have to you still want a short hedge, but you can't have it in March. So you want to move it on to the next month. So what you will do is, instead of closing out just the March contract on that day, you will actually do a spread transaction where you will sell and buy March, April. Okay, sorry, you will buy and sell March, April. So March against April. So what you'll do is you'll sell March and you will buy April simultaneously. It'll be done as one contract. The net result is, since you are already short March, you will now do a buy-sell, okay? Buy-sell March to April. So you will end up getting short in April and the March will become zero because you were short and you buy, and so that becomes zero. And this becomes short. Now this becomes, so you're still carrying a short hedge, but you're carrying it in the next month. Okay, and this will run till 15th April, roughly, approximately. Okay, so this is another thing that you have to keep in mind, that you're hedging with futures. So you have to you may have to roll over the hedge, because the contract in which you have the hedge, that hedge has, the hedge is still required, but the particular contract is maturing, or the last trading date is approaching. So you need to get out of that contract. So, but you still need the hedge. So what you do is, if you are short in March as a short hedge, you do a buy-sell March against April, buy and sell March against April. So the buy in March cancels out the already short position in March, and you end up with a net new short position in April. Okay, so this is a spread transaction. We will deal with these spreads once again in the future formally, but I'm just highlighting the procedure to you. Okay, so the point to note is different prices for different maturities, as you have seen here, even before for crude oil. Okay, mainly because of time value of money. So obviously, if you can make all interest rates zero, then there's no time value of money and everything will have the same price. Okay, even there in commodity markets, there may be some dislocation because physical disruptions and things like that. And these are physically deliverable commodities, but generally it should all trend to, in the case of financial futures, that will all become zero, all become the same price, because the time value of money is zero now, because the interest rates are all zero. Okay, so this was the point that we were discussing the other day, just going back through what is the net import of all that we discussed just now, that when you're dealing with hedging the Japanese yen and the Aussie, because these are currencies, and you know that in the case of currency markets, the main liquidity is in the spot markets, which is here. Here you have the spot market prices from Nettanya here. You can also bring them up in your IBTWS. You will see that if you do USD.JPY, you will get the spot price. This price will come up. Okay. And these are also tradable prices, like they're saying real-time tradable rates. So these are tradable prices. Now they've become much more authentic. Earlier, they used to be indicative prices, okay? Now these are much more authentic now. So therefore, these are spot rates, okay? With dollar as base currency, you can see the convention here. So you do your analysis in this way, form your view. When you need to hedge, you go into the futures market and hedge in the futures contracts, decide which month you want to use, just pick the month with the highest volume, okay, provided it is equal to or earlier than your hedge maturity, underlying position maturity. If you need the hedge only till February, then don't go and hedge in March. Okay, that doesn't make much sense. But what you should do is, typically the requirement of the hedge is beyond March or beyond March, then you hedge in March, which has the highest volume. Okay, so this is as far as this is concerned. And then you have the Aussie. Aussie is not a problem because when you look at the spot Aussie, it's not taking the. When you look at the spot Aussie, and you want to look at the spot, if we look at Japanese yen and then we look at other currency futures. We actually have these, I think. Yeah, we have some of these. We don't need to go through that. So the thing to note about Aussie, here you look at this. Aussie as spot Aussie is quoted as Australian dollar as the base currency and US dollar as the terms currency. So you can see the price now. It's around 77.20 roughly, 77.20. Okay, roughly 77.20. You can see that here as well, Aussie dollar, 77.20 roughly. Okay. So, and when you go to hedge, there is no problem because you can see the price is also 77.20 because the convention in these currency futures, you notice here the contract size is different. Okay. And you can see here the same convention for the maturity, the last trading day, determination of the last trading day. And what was I saying here? You can look at the quotes for the Australian dollar and they look the same. Because here, in the reason they look the same is that the futures rule remains the same. The futures rule is consistent for all the futures contracts. For all currency futures contracts, the US dollar is the terms currency and the foreign currency, remember these are American exchanges. So these are, US dollar, these are United States exchanges. And so the home currency of the United States, the US dollar, is always taken as the terms currency for all the CME currency futures. So in this case, Australian dollar is the base currency and US dollar is the terms currency. And in this case, what has happened is what is not consistent is the spot market conventions. In the case of the spot market, in certain markets like Aussie US, Euro US, Sterling US, Kiwi US, in these cases, the dollar is the terms currency. But in other cases like dollar yen, dollar Swiss, okay, dollar Singapore, then even our Indian rupee, all these cases, the dollar is the base currency. So it is the spot market which has inconsistent conventions, but the futures markets has the same convention. So you have to adjust to this and keep an eye on this as you trade. Okay, so this is basically what it is. Okay, as far as how you're going to trade. Now we'll come to the discussion of the underlying positions. Okay, now let's look at. So what we were saying is, so they were right that so many of you pointed out these currency exposures as far as we were discussing the key risk factors. Okay. So you guys pointed out the key risk factors, and we had an extensive discussion from the last part of the previous session and the early part of this session as to how you are going to manage the currency risk on how you're going to manage the risk on the currency futures contracts, in particular in the case of the Japanese yen, where you will find it a little confusing because the spot market, which you have to look at in order to form your view, is quoting with dollar as base currency, with the US dollar as base currency, but the futures markets are quoting with the yen as the base currency. So you have a little bit of a problem and you have to deal with that, okay? So, all right, okay. So now that's one more example of a problem that Srishti pointed out, which I think and nobody else pointed out. She mentioned a key risk factor as the 3-month US dollar interest rate, 3-month US dollar LIBOR, because she highlighted the fact that if you see, we have this information in the case. What is the information in the case? So you have the Aussie loan and the yen loan, because of which we have some exposure to the Australian dollar yen exchange rate and the Aussie dollar US dollar exchange rate. And then something else which Srishti pointed out, which is the US dollar loan is at, so you see here the US dollar is 5-year maturity. Interest rate is indexed to 3-month USD ICE LIBOR. Okay. Does anybody know what LIBOR is? What does LIBOR stand for? Actually, this
it stands for the interbank rate, London.
Yeah. So the correct answer would be
London interbank offer rate.
Should be London interbank offer rate, right? So this is what this is Mithali, right? Who answered this?
Nikita, Sir Nikita.
Nikita, okay, fine. All right. Okay. So this should actually, therefore, I should write it as LIBOR because it's an acronym. So it's London Interbank Offer Rate. Okay. So this, you should be familiar with this part of it. The L is for London. Now, this remember this, because in most interest rate indices, you will find this component coming through. Okay. So you'll find Euribor, you'll find MIBOR. MIBOR is for Mumbai. Okay. So you'll find TIBOR for Tokyo, T for Tokyo. And so remember this. So this is basically for the interbank offer rate, which means that the rate at which, let's call it this way, let's put this down. London, actually you can see it, okay? Interbank. Okay, interbank offer rate, which means, okay, let's take the prompt, interbank offer rate. All right, so what this means, I'm just going to use a shorthand for, if this is for interest rate, I'm using this rate symbol, okay, at which banks will lend to each other. Okay, so this is banks are not lending to Nikita or to Airtel. Banks are lending to each other, that is to other banks. So it's a wholesale lending rate, and this is an indicative rate. Okay, so the problem, and there was a big scandal with LIBOR. You can read up on the LIBOR scandal if you want to, but because these rates are not based on actual transactions, these are based on, we call up a bunch of banks. You call up Citibank and say, okay, what is your interbank offer rate for 3 months, for 6 months, for 9 months, etc. Then you call up JP Morgan and you ask them the same question. Then you get a whole bunch of responses for different maturities, and then you take out the top one and you take out the top and the bottom, remove them, the top two extremes, and then you take an average of the rest, and that's your interbank offer rate. Okay, but the problem with this measure is that it was based on a survey. Actually, it's a survey-based measure. It's not based on actual transactions. So there was a lot of fudging, etc., which happened after the global financial crisis set in. And there's a major scandal. A lot of people went to jail. So people are now moving away from this index, but it is still true that a huge amount of loans, trillions of dollars of loans, are indexed to LIBOR. So the bottom line here is that it is a 3-month US dollar. ICE is just an exchange, okay, intercontinental exchange. They renamed themselves as ICE, and they are now administering this rate. So we call it ICE LIBOR as a branding. It's a branding element, okay. It's like Amazon Prime, that kind of thing. So ICE is just an exchange. So the point about LIBOR here, you have to understand why Srishti is right in calling it in saying that the 3-month interbank, 3-month US dollar, euro dollar deposit rate is a risk factor, is because the 3-month LIBOR is a risk factor. Because this is how it works. Okay, let's look at the floating rate, how it's going to work. Let's look at this. Let's use your this worksheet here. So this is yeah, okay. So let's look at a loan which is let's say for 5 years. So 2, 3, 4, 3, 4, 5, 6. Okay. So if we, let's say we want to fit everything in one view. So let's call it like a 6-month LIBOR. Okay. So we have a loan that is going to run for 5 years. Okay. So here 3 months, then 6 months, then 9 months, then 12 months, then 15 months, then 18 months. Okay, in the first 3 months. Okay, so 3 months, 6 months, 3 months, 9 months, 12 months, then 15 months, 18 months, and we need then we extend this a little bit. 12, 15, 18. This should be 19, 20, 21. This should be 21 months and 24 months. Okay, is that what we got? Okay, so it's a 2-year loan. Okay, it's a 2-year loan. Now what's happening is that this is the loan period. Okay, so you have to pay. Let's assume it's a bullet repayment of principal. So you have to pay the principal back after 2 years. Okay. Now the way the LIBOR system works is this is the loan is valid. The principal is outstanding for the entire period, and the interest rate is being reset every 3 months. Okay. So I got confused because I was going to set it up as 6 months and then I went back to 3 months. Okay, never mind. So it's a 2-year loan. What we're looking at is a 2-year loan, which is indexed to 3-month LIBOR. Okay, so how is this going to happen? This is going to be basically one setting here. Okay, we can give it different colors to show that different rates might apply. Okay, let's look at different colors. Okay, the idea of different colors is all different rates are applying. Okay, so well, need not actually be different, but they could be different. Okay. That's my point. Okay, so that's the thing, right? Let's give it some. And what else? Okay, we have no choice. We need one more fancy color. Okay, we'll give it some. Okay. So this is the whole point of this. The point is that so when you take the loan, when you take a two-year loan, okay, you get the bank disperses the money, it goes into your account. And so the first 3 months interest rate, now this is always, remember how your interest rates are set in the bank. When you put on a 3-month deposit with HDFC Bank, fixed deposit, you know today, suppose they are giving you 5.5% for 3 months. Okay. Now the point is you're putting in the deposit money today, and you know that at the end of 3 months you're going to get 5.5%. But you're not getting the 5.5% today. You're not getting the return today, but the return is known today. Okay, so the interest rate is set in advance and paid in arrears. So we say here that the rate is, okay, deposit rates, okay, quoted on PA basis, okay, That's one. Okay, they are quoted on a PA basis, per annum basis. Okay, so and then they are set in advance. This is true about and paid in arrears. Okay, so maybe this will not fit in one. Let me just put this into. So for all deposit rates, we say that they are quoted on a per annum basis and they are set in advance. We can actually, this is one characteristic, okay? And the other characteristic is they are set in advance. And so this is the language that we use, paid in arrears, okay? So later on, you'll see there is something called a LIBOR in arrears swap. When you look at the different types of swaps that are available on the market, there's something called a LIBOR in arrears. What does that mean? That's basically we are referring to any period. If you are dealing with 6-month LIBOR, remember LIBOR is an interest rate, okay? So on any given day, you could have LIBOR for, let me see if I have a picture of ICE LIBOR. These guys have become, after they started setting the rate, earlier, you could just go to the British Bankers Association website and get the page and get the data on today's LIBOR fixings after a couple of hours. But in fact, they would be published on Reuters. But now that these guys have taken over, they have become very, very coy about the data because this is an important piece of information. And so, what is the LIBOR fixing? And these guys have become very coy and they don't want to give you the information and all that. So it's very strange. It becomes very painful to get hold of ICE LIBOR. Okay, I got you a hyperlink here. You can go and read on this. Okay, go and read up on LIBOR, what is going on. Okay, so LIBOR is okay. Let me just give you this information here. The same thing. Okay, now LIBOR is they dropped some of the currencies. The Australian dollar, Canadian dollar, these were all dropped. Okay, so now they're doing LIBOR calculation for 5 currencies and 7 tenors. Okay, overnight. Okay, overnight spot next. Okay, 1 week, 3, 2, 4, 5, 6, and 7. Okay, so 1, 2, 3, 4, 5, 6, and 7. Yeah. Okay. Now you have, so these are the different maturities, okay? And so the point is basically because LIBOR is an interest rate, so any interest rate, you have to always know what maturity it applies to. So if you look at HDFC Bank fixed deposit rates, 3-month rates will not be unlikely to be the same as 6-month rates and 9-month rates and 12-month rates and all that. So always look at the period for which it applies, okay? And I just want to see some of the rates, but they have not shown. These have become very coy about the rates. Now, why can't you give us some little bit of historical information, at least 1 day late information? See how difficult it is to get the data now. Okay, never mind. You can read about all this methodology for LIBOR and all that. You should know about these things because these are all related. These are all important things in the market. But anyway, so there's a bunch of rates, okay? So the point about a 2-year, the point about why Srishti is right about this being a key risk factor. So what you're looking at is 3-month LIBOR. I got a 2-year loan on 3-month LIBOR. Now what's happening is when I take the loan, the rate for the first 3 months, I know what the rate is, whatever the LIBOR is fixed on that day, okay? And that's basically, so if the fixing is on, is the fixing is today, okay? Let's put the interest accruals. Interest accruals start from T plus 2. Okay, interest accruals start from T plus 2, which means that in certain markets they may be a little different, but mainly we're talking about LIBOR at least. Okay, at least for LIBOR, which is the most important rate. Some markets may have different conventions, but generally for LIBOR and other international interest rates, what does that mean? Interest accruals start from T plus 2, which means if you're looking at today's LIBOR rates, okay, a real problem now getting hold of the LIBOR rates. I just want to look at some LIBOR rates, the last setting of the LIBOR rates. And these guys have made it so difficult to look at, to find these things. See, delay of 24 hours. Current LIBOR interest rates. Yeah, Euro LIBOR. Okay, yeah, you can see now. Euro actually is dealing with. Euro is actually looking at negative interest rates. Let me just look at this. Okay. Let's look at US dollar LIBOR. Okay. See, this is what I'm talking about. These guys have started now charging rates, and it's become a real pain getting hold of LIBOR data. Anyway, so look at this current US dollar LIBOR, okay? 18th. So we got data for 18th. This is your US dollar LIBOR. You can see this, okay? 1 month, 2 months, 3 months, etc. Okay, now this is the most important rate, actually, 3-month LIBOR. Most of the trillions of dollars of loans in the international capital markets, debt capital markets, they are based on 3-month LIBOR. Okay, this is a very important benchmark, 3-month LIBOR. Generally, all the rates will tend to move together, but they need not move by the same amount. Okay, so this could go up by 10 basis points. This could go up by 8 basis points, and so on. So this is a very important point on the yield curve. Okay, this is what is called a yield curve. Interest rates for different points of time, different maturities. Okay, you can also look at Axis Bank fixed deposit rates. That's also an yield curve, because you got interest rates for 1 week deposits, 1 month deposit, 3 month deposit. So whenever you see interest rates for different maturities, that's called a yield curve. Okay, so now this is basically the very important thing, US dollar 3-month LIBOR. Okay, now let's try and get hold of a Fred chart and tell you why this is important. Okay, Fred effective federal funds, and actually I need 3-month LIBOR, but we'll search for it. Interest rates. Right. So basically, let's look at how the loan will function. How is the loan going to function? Now you see this rate, okay? 1 minute. Yeah, we got this, right? So let me give you a link to this, so that you have at least a link. You can check what the LIBOR. It's always very important to get a feel for market rates. Where is the market today on this? What is the, especially for you guys, because you're just coming into the market. So you need to really, get your feet in the water and get a feel for what it's like. So it's very important for you guys. That's why I'm very angry that these guys have made it very difficult to get the rates.
Pros, PRO, Bengali pros. Rituals.
Okay, who is talking now? Who's talking?
और फिलोसफर कौन होता है? मार्गदर्शक नहीं.
You guys need to put yourself on mute. Somebody is talking. Who is this?
लिखना और फिलोसफर.
Akshata, who are you talking to? You should be on. Yeah, you should be paying attention to in the class. Okay. Anyway, so this is the advantage of Zoom classes, that you can just do whatever you want. Okay, but at least put yourself on mute. You can do whatever you want, but you can at least put yourself on mute. Okay. What was I saying now? LIBOR. Okay. You guys need to have a look at this, get a feel for LIBOR rate. So I've given you a hyperlink. Okay. So we were trying to see what happens. Interest accruals start from T+2. Okay. Now, so what happens? Say Srishi takes a loan for 2 years, and that loan is indexed to 3-month LIBOR. So today she gets an agreement on the loan. The loan will be disbursed T+2. So today is what? Wednesday, no? Today is Wednesday, yeah. So let's assume there are no holidays tomorrow, day after. So then her disbursal happens on Friday, Thursday, Friday. T is Wednesday. T+0 is Wednesday, T+1 is Thursday, T+2 is Friday. So Friday, the money comes into her account. the interest accrual starts from T plus 2. So from Friday, her interest burden is starting to be, accrued, okay, whatever interest she has to pay. So that rate, whatever the fixing of the 3-month LIBOR is today, okay, so let's say that we look at this page and we see 3 months LIBOR is 0.224. So that means that this 0.224 will apply from Friday. We see the rate, the fixing is today. We assume that 0.224 is the fixing of LIBOR for today. And then this will apply from Friday for the next 3 months. Okay. So then Shrishti will pay interest on her loan from Friday to the next 3 months at the rate of 0.224. So there is no uncertainty about the first period's interest rate, because at the time that she gets the loan is sanctioned. We look at that day's LIBOR rate, and then 2 days later the money is disbursed and the interest rate accrual starts. So it's going to be for the first period is 0.224. The problem is, what's going to be the rate for the next 3-month period, the next 3-month period, accrual period? That nobody knows. Okay, that's the problem. That nobody knows. That we have to wait and see for another approximately 3 months. So basically from today, 3 months plus another 2 days, we'll have to see what happens after. So actually 3 months, not another 2 days, but 3 months from now, again, we will look at the LIBOR setting. But who knows what the LIBOR is going to be after 3 months, okay? That's the chart I was trying to show you, LIBOR rates. Let me see. So these guys have made it so difficult to look at LIBOR rates now. Let's see when it is. 2021, 112. Okay, that's a little bit percentage daily. 3-month London interbank offer rate based on US dollars. Okay, let's have a look at this. Yeah. So this is a very good website. I think I've given you this website before. Fred. This is the St. Louis Federal Reserve Bank. Okay, Federal Reserve Bank of St. Louis. They have very good data actually. So if you're doing any data analysis, you can look at this. Where is the max? Shall we go for max? Yeah, there you see. Okay, now you see this 3-month London interbank offer rate, LIBOR. Okay, which is how has LIBOR moved. Now you see at in the time of March of 1989, LIBOR was over 10%, 3-month LIBOR. Okay, March of 1989. In fact, in the 1980, if you look at this chart, does not go back far enough. It starts only from 1986. So if you get the data from much earlier, from the 1950s, you'll see that in 1980 the rate was even higher. It was around 15%. It's somewhere here. Okay, late 1979, early 1980. So that's how high it was, 15-16% for 3-month LIBOR. So that is the kind of, and now you see where it is. Okay. This is basically after the global financial crisis. The central banks aggressively cut rates. These gray zones are recessions. Okay, the gray zones are recession. This is the global financial crisis and the accompanying recession. Then they cut rates drastically. They kept it at 0, and then pretty much around the beginning of the first Trump term, they basically started raising the rates rapidly. And then again, the COVID thing came, and then they started going. Basically, even before COVID, they were cutting it, okay, because there were some problems coming up in the economy, and they started cutting. And then after COVID, again, boom, back to 0. So you can see. So the point here is that by looking at this chart, you can clearly see why Srishti is correct in terms of this being a risk factor. Okay. 3-month US dollar LIBOR. We can have this here. We'll put this here as a chart. Okay. Or maybe we can put it here. Let's take this and put this chart. It's a very important chart actually. This is why you need to, you have to understand what happened in the global economy. That's why one of the important aspects of your training is to be able to just ignore this some background noise. You should be going through these kinds of databases like what you have here on the Fred website, and look at what happened to 3-month US dollar LIBOR. That will tell you a lot about the history of the global economy. So here you can learn about the petrodollar crisis and the global financial crisis by looking at major interest rates, like major interest rate, major equity prices, You can go back through, follow the history and ask yourself, okay, why did it fall like this at this time? What was going on in the economy? So this is how you learn about finance and the history of global finance. So a lot of finance learning is learning about economic history. If you don't know your history, you will get into trouble. So it's very important to learn about economic history. And I'll try to give you some more books which deal with history. So far, we've been focusing on conceptual books for concepts, but I'll try to pick out some books for historical, lessons. But remember that chapter I gave you from the Hull book? I think some chapters, I'm not sure exactly what it was. There's a chapter 36 or something like that where I've told you. Chapter 8 is for the global financial crisis, I think. I mean, just check the chapter numbers. I'm not 100% sure. And then there's a chapter on the risk management disasters towards the end of the book. You should read that also. That's also part of your learning. You have to know where people messed up so that you don't make the same kind of mistake, right? Okay, so the point is, now you see what the problem is. The 3-month LIBOR is a risk factor because it's a key risk factor because it can fluctuate quite dramatically. Of late, it has not been fluctuating. You could say that is one of the reasons why many people are taking floating rate loans, okay? That you could look at it and say, hey, look at this. Now, from May 2009 onwards, it's hardly moving. And then, okay, it started moving up in 2016, but that's a long period. From 9 to 16, if I can get like 7 years of low interest rates, and now again it's down, and now the Federal Reserve once again is saying because of COVID, they're giving assurances that we will not raise interest rates, don't worry. Which means you've got a blank check for borrowing at low interest rates, at floating rates, okay? And you borrow at floating rates and just enjoy the low interest rates because there's no risk effectively. Strictly speaking, there is risk, but effectively there's no risk because the Federal Reserve is guaranteeing that they will not raise interest rates. And this dollar LIBOR rate, it cannot go out of line with the Federal Reserve rate too much, okay? Because it's an offshore rate. This is an offshore rate, and the Federal Reserve lending rate is an onshore rate. That's an overnight rate, and this is a 3-month rate. But there is still a big connection because their maturities are not too far away. So the point is this. Now, so basically the point is that still when we learn the theory of corporate risk management, so basically this is the idea that because you can have this kind of fluctuation in the 3-month LIBOR rate, the problem is here, you don't know what, when you start out taking the loan, you only know the rate for the first reset, for the first period. Second, third, fourth, fifth, all the other periods, you don't know what the rate is going to be. It could be anything. It could be much lower. It could be much higher. So you don't know what. So that's why we say this is a key risk factor. The 3-month LIBOR is a key risk factor in this kind of a balance sheet where the dollar loan, we call this a floating rate loan. Okay, this is called a floating rate loan because the rate is moving around, so it's floating. It's not a fixed rate loan. Whereas if you see here, let me just call this, so to teach you this terminology, we say that the dollar loan, which is at interest rate index to 3-month LIBOR, this we call a floating interest rate. Okay, and this is a fixed interest rate. In the case of this should be, for consistency, this should be shown like this, and it should not be. Yeah, okay. So this is the fixed. So to show you that fixed and floating are like tall and short, black and white. We use them in contradistinction to each other. So in the case of interest rate, discussing the type of interest rate. So the Aussie dollar fixed interest rate of 5%, which means that if this represented a 10-year period, in the case of the Aussie loan, it's a 10-year period, then that 5% applies for the whole 10-year period. Okay, every period's rate, if it's a semi-annual payment, okay, whatever, every 6 months, you'll be paying at the rate of 5%. So there is no uncertainty at all. In the case of the Aussie loan, there is no interest rate risk. Remember, if you remember when we looked at market, we looked at one of the categories was called market risk. And I mentioned that market risk has to be further split up into if you looked at let me get that page up here. Yeah, so here, if you have this, so if you remember, we have a taxonomy of risks where we have market risk, credit risk, and all kinds of, operational risk, legal regulatory risk, liquid financing risk, etc. And mainly on risk book management, when it comes to treasury risk management, we are concerned mainly with credit risk and market risk, and most importantly with market risk. But when you're looking at market risk, you have to look at further split up market risk in this manner. Okay, you have to go asset class by asset class, and you have to look at it instrument by instrument. This is how you analyze market risk. Okay, so therefore what you do is when you're looking at the Aussie dollar loan part of it, okay, this is your balance sheet. You're looking at the Aussie dollar loan because the interest rate is fixed. This one has only foreign exchange risk. It does not have any interest rate risk because the interest rate is fixed. So that's the point I was trying. So these kind of distinctions you should be able to make when you analyze a particular passive risk book. You're analyzing the balance sheet and trying to understand exactly where the risks are, what types of risk exist on this book, so that you can manage it actively, right? So when you look at the yen loan and the Aussie loan, you say that these loans have only foreign exchange risk. Aussie loan has an 8-year maturity, interest rate is fixed at 275. Aussie loan has fixed rate of 5%, okay? So there is no interest rate risk on the Aussie loan and the yen loan, but of course, as Vipul and others pointed out, there is a foreign exchange risk. Okay, there is foreign exchange risk because of the fluctuation of this rate and this rate that will change the market value of the yen and the Aussie loans. So therefore, there is a foreign exchange risk, but there is no interest rate risk. You come back to this framework. Okay, how did you analyze? So you looked at the balance sheet and then you looked at all the currency risks. Okay, you can take the spot currencies. So currency spot, you looked at the balance sheet and you said, okay, I got a spot currency problem here, I got a spot currency problem here. Nothing on the asset side, but on the liability side, I got 2 spot currency exposures. Okay, and then I will manage them using futures contracts. So therefore, this is the kind of analysis. But when you do the interest rate analysis, similarly, you move through the quadrant through the matrix, and then you come to interest rates, and you look at whether interest rates you have any risk. Okay. When you come to this on the interest rate side, here and here, you say that, okay, here we don't have any interest rate risk because the interest rates are fixed. So we can predict all the cash flows. Because everything is fixed, we can predict all the cash flows that will occur at these points. Here there'll be all the I payments, and then there's a P plus I at the end. Okay, just like your typical bond cash flow. So we can predict all the interest rate cash flows because everything is known with certainty. The liabilities are fixed, so there is no interest rate risk, but there is currency risk. So this is how you need to analyze risk, okay? Remember, market risk has to be further split along these lines. So this is how you should be thinking about it when you look at these things. Right, so you have understood now that 3-month LIBOR is also a key risk factor. Okay, so that becomes, so if you look at our answers to key risk factors, okay, that becomes essentially what are our key risk factors. In this case, we have, you can take the futures prices for gold, copper, and West Texas, okay, and then you can take in the case of yen and Aussie, you say that the exposures are basically the spot yen, spot dollar yen rate, spot Aussie dollar US dollar rate, exchange rate, and then you got the last one, which is the 3-month US dollar LIBOR. That's your last risk factor. So you got a total of, basically you got a total of 6 risk factors, key risk, 6 KRFs. Okay, 3 on the asset side and 3 on the liability side. Okay, any questions at this point? put it in a light color. You can read it. Yeah. All okay? Okay, fine. Let's have a look at what is the case asking us to do now. We got the information on the case. Okay. So this is a very bare bones case, as you can see. I have written it just like the spreadsheet. The balance sheet is also very bare bones. It's not an elaborate balance sheet. The spreadsheet is also, the case information is also very bare bones. I don't have stuff here like saying Mr. Smith looked out of the window on a cloudy day and the puffs of smoke were coming out from his mouth after he's puffed on the cigar, and all this storytelling. There is no such thing that is there in this case. It is all hardcore information which you have to analyze, which is useful, which is required for to clarify the concepts that we want to learn through this case. Okay. So we have covered the risk factors. What is the next question? Underlying positions. Okay, so let's go and find out the underlying position. Now we know. Okay, so key risk factors and key risk factor market is basically just where the price. The price that is the key risk factor, that particular corresponding market is the KRF market. Okay, so we just say what are the KRF markets? Okay, what are the KRFs? And so basically, because I'm asking you here about underlying positions, positions always exist in some markets. So therefore, I'm asking it as a market. Okay. So mainly, what are the underlying positions? So look at this. Is this the case? Yeah, okay. Right. So what are underlying positions? Okay, let's go one by one and let's find out who is a sleeping beauty here. Let's find out. Okay. Okay, let's ask Saloni. What is the underlying position with respect to gold? I just mentioned gold as a market, okay? I'm not going to mention gold futures just to save time. So, what is the underlying position with respect to gold for magma? Do we have any answer? Okay, so Saloni is sleeping. We have to have some kind of response, at least in the chat box promptly. Don't come back later and say that my network is down or something like that. Okay. Okay, let's find out who else is sleeping. Let's ask Kritika. Can you tell us what is the underlying position for magma resources in the case of gold? No. So Kritika is also sleeping. This is the beauty of of Zoom classes. You can just put on the thing and go to bed, go to sleep. Yeah. Okay, let's ask Jakhar. Can you tell us what is the underlying position with respect to gold? Jakhar is. Are you guys able to hear me? Who is normally awake? Let's ask Nikita.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Okay, good. Jakhar, you're also sleeping. Okay. The beauty of this is the advantage of Zoom classes. Even the men can become sleeping beauties. So 1 minute. Who else is sleeping? Let's ask. Okay, Abha. We will come to Sachin. Abha, can you tell us what is the underlying position with respect to gold? Abha is also sleeping. A lot of people are sleeping. That's why there's so much pressure on me to analyze the to update the attendance so that people can just, instead of sleeping in the class, they can just stop attending altogether. Okay, we'll come to that. Okay, let me. Okay, 1 minute. Okay, now let's go to the hand raised people. All right, let's go. First, we saw Sachin. Let's go with Sachin first. Yes, Sachin.
Sir, can you repeat the question?
Yeah, so what is we want to go quickly through the underlying positions in because what is the question in the case? The question in the case is what are Magma's underlying positions with respect to each KRF market? Now, in the first question, we have identified 6 KRFs for Magma, right? We have identified 6 KRFs. Now we are asking, now 6 KRFs and KRF market means, in this case, we said that the price of gold is a KRF, right? You can call it the spot price or the futures price. We'll just say price for now to shorten the, to cut down on the number of words. We'll just say gold. Could be spot gold or front month futures gold. We'll just say gold price. And so therefore the KRF market is the gold market. Okay, so the KRF is the gold price and the KRF market is gold. Now therefore the question is, what is Magma's underlying position with respect to gold?
Long.
Okay, so this is Sachin is answering?
Long.
Yeah, okay, it is long. Okay. And why is it long?
Because I'm unable to explain, sir. I think it is long.
Sir, Abha, this side, sir, I was not able to unmute myself that time. But I don't know the answer. I'm not sleeping.
Okay, you're not sleeping. Okay, 1 minute. Let's see. Let's put this hands over here because I can't see. 1 minute. Okay, let me just 1 sec. Let me just. So Sachin is not clear about this. Okay, so 1 minute. Okay. All right. Okay, so let's go to the other hand raised people. Let's ask Gaurav. Yes, Gaurav. Let's ask you.
Long position.
So let's ask you about copper now. I want to just distribute the questions a little bit. What is the case? What is the underlying position with respect to copper?
A long position.
Long position. Why?
Because they mine or produce copper, so they are naturally long.
Mine is now. What kind of logic did I teach you? If you remember, a couple of sessions back, Utsav gave an answer about why some position is long or short when we were discussing all these cases like Saudi Arabia, Saudi Aramco, India, and their exposures with respect to the gold to the oil price. We had a long discussion about India, about Saudi Aramco, and
Prices of copper rises, they will benefit from it.
okay, and if
sorry.
Yeah, your answer is not complete. I am asking you why is it long? You have to give me a proper justification. Your answer is not complete.
That if the price rises, they will benefit from it. And if the price decreases, they will lose money. So they are long in copper.
Okay, 1 minute. I'll come to the others. Okay, now next is let's go to Vipul. Okay,
Yes, sir.
Double A. We'll come to double A. Yeah. Oh my God, there are 7 people with hands raised. Yes, Vipul, tell us with respect to copper itself. You can tell us.
Copper, it's a long position because, sir, if the price of copper increases, the price of assets will increase, and sir, from that, sir, their net worth will increase, and sir, this will profit them. And sir, if the price decreases, the overall valuation of assets decrease, and sir, the net worth will decrease.
Sir, I'm not able to raise hand. I also want to answer.
Who is this?
Sir Utsav.
Utsav, okay. You're not able to raise your hand. Maybe there's a limit on the number of hands that can be raised. Everybody's got their hands up. Okay, 1 minute. Let's take down the hands, some of the hands that we have. Okay, 1 minute. I think we have so many hands up today. Okay, so Vipul, you can lower your hand now. Let's get some hands down because otherwise we'll have Utsav has also raised his hand. Okay, let's go back to Srishti now. Let's go some of the older hands which were raised from earlier. Okay, yes, Srishti, what is the answer? Let's ask Srishti about West Texas Oil. In oil, what is Magma's underlying position and what is the justification for that?
So, looking at the nature of business, Magma's position with respect to West Texas Oil is long because if prices of West Texas Oil increases, P&L of the company would go up, and if prices decrease, P&L would go down. That's why when the company's position is long, it has the same behavior.
What is that last part? What I did? You just went murmur. What is the last part? When? Can you repeat the last part?
Yeah, sir. Sir, I was saying that looking at the nature of business, if
That's
prices
okay.
of oil increases,
Last part I didn't get. The last part.
if prices of oil decrease, P&L of company would reduce, and this kind of behavior is shown when company has a long position with respect to the asset.
Okay. Okay, fine. Now you can lower your hand. Now we'll go. Sachin has already answered, right? So Sachin can lower his hand also. Now we'll come to double A. So let's get some hands down because we got too many hands up. Let's say double A. Let's take you back to gold. In the case of gold, what is your assessment? What is Magma's underlying position and why? Double A.
With respect to gold, it should also be long.
Yeah.
Because, sir, if the market goes up, the Magma Resources will make money, and if the market goes down, it will lose money. And the position should be long.
Okay. So double A, you can lower your hand now. Let's go to Nikita.
Yes, sir.
Yeah. Yes, Nikita, what is your, let's go take you back to copper. In the case of copper, what is the underlying position and why?
Sir, the underlying position is long because as prices of copper will increase, their profit will increase, and as price of copper goes down, their profit will come down.
Okay. Again, somebody, I don't know if it's Nikita, but somebody, the background noise is coming. Okay, Nikita, lower your hand. Mitali, let's ask you about crude oil for West Texas Oil. What is their underlying position and why?
Yes, sir. It is long because, as mentioned by other students also, like if the company if the price will increase, the company P&L will increase, and that's why the company will make a profit. So they will go long on this position.
Okay. Okay, fine. Okay, fine. You can lower your hand. Okay, let's go to Utsav.
Yes, sir.
Utsav, you can tell us also about West Texas Oil.
Sir, it is long because of the reason that the other people, other students said. But I also think it is long because the number of units are in positive. If it would write in short, according to me, the units would have been in negative.
Okay, that is also a mathematical way, but we want to look at the original logic. Okay, that
yes, sir. Original logic stands that also stands that if the price goes up, the company will benefit, and if the price goes down, it will lose. Apart from that, I am saying that the number of units generally when a stock is short, the units are in negative because we don't have it and we are trading in it.
Okay, fine. So in this case, yeah, you're looking at it. But if I had just told you that they have inventories of crude oil, and I don't tell you the number or anything like that, they have inventories of crude oil. A mining and energy company has inventories of crude oil. So what is their position with respect to crude oil? then in that case you don't have this business of numbers being shown. So you forget about that part. You're not wrong on that part. You're right about that. Okay, but in this case, your logic would be that what is it? Just repeat it. In this case, just because you're answering, so you should give a full answer. What is your answer? That this is you're saying answer is long. Why?
Sir, because when the prices of one of these assets goes up, the company will benefit from that. And if the prices goes down, the company will lose money. That is, it will be in sync with what is the condition in the market.
Okay, fine, no problem. Okay, fine. So we're done. So we'll just go through this and just quickly reconfirm for anybody else who is not clear. So in this case, we are trying to answer this question in the case, what are Magma's underlying positions with respect to each KRF market? Okay, first you identify the KRFs, which are the prices which will fluctuate and cause the value of assets and liabilities to fluctuate. Those are your KRFs. So we identified 6 KRFs. And whichever markets, whichever are the markets to which these KRFs correspond, okay, those are your KRF markets. So these are the terms that we use. And so for each KRF market, now we want to understand, we have 2 important things to assess when we are looking at risk management. The first 2 things to assess is look at the KRFs and then figure out your underlying positions. Okay, so we are figuring out the underlying positions for each KRF market. So on the asset side, we looked at all 3 commodities, and as you can see, what is happening here? Let's increase the price of gold. Okay, let's make it like 1610. Notice what happens to the net worth figure. Okay, it's 2.37. Okay, what happens? 2.6. Okay, so net worth goes up. Okay, which means the PNL impact is positive. Corresponding PNL impact is positive. I'm going to do a Control Z so that we preserve the original prices. Okay, same as is true for gold. Okay, let's see this for copper. We make it 5. Again, it goes higher. The net worth goes higher, so it is having a positive impact. Lots of noise coming. Again, people are not on mute. I don't know why so many voices are coming, so many noises are coming. You guys need to practice this discipline. Make yourself on mute because it's hard for me to go through every page and look at everybody's icon and see who's. Ashwarya is the one who's not on mute. Okay. So yes. Okay. So we just tested it. 2.8. 1 minute. I hope I changed the number. It's 2.807. Yeah, if we can increase the decimal, yeah, it's 2.8. In the case of oil, we increase the price. Look at the net worth. 2.37 is the original net worth. Increase the price, it becomes 2.83. Okay, so what we are seeing is that, so the correct way to answer this question is that we look at it and we see that the situation is such that, let's do a Control Z, bring the prices back, that in the case of these inventories, when the prices of these, KRF, in these KRF markets, the prices go up, then the impact is positive on net worth, which means there's a positive impact on PNL. And conversely, we don't have to waste our time doing that, but conversely, if we reduce the price, then net worth will go down, which means PNL will be negative. So therefore, to answer the question properly, what we have to say is, and it is only a long position that behaves in this manner. Okay, so that we have to say that this is only a sort of complete, because remember, you're answering everything not to me as a human being and you're a human being. We can fill in the gaps. You have to always practice answering everything as if you're talking to a computer. A computer can't fill in any gaps. So you have to answer everything in the correct way, repeating everything, because computers can't fill in any gaps. So that is how you should be training yourself to answer questions, because that will also force you to think in that kind of rigorous manner. Okay, that completes the answer. Now let's come to this. Okay, dollar yen and let's come to the liability side. We got 3 list factors: dollar yen exchange rates, Aussie dollar exchange rate. Yes, Vipul. Oh, you got another somebody else also. Srishti also has. Yeah. Yes.
Sir, to answer the underlying asset for liability.
Okay, you want to talk about the dollar yen. Okay.
Yes, sir.
Okay. What is your answer on dollar yen?
Sir, short.
Okay.
The short underlying position is short because, sir, if the dollar yen uh, decrease in respect to USD, then it will increase the net worth and will increase the PNL of the company. And sir, the short position, that this kind of behavior will be in the. Sir, I don't get the last line.
So now I understand you have understood conceptually what is required to be said, but now you notice this is why I force you guys to talk as if, give a full answer as if you're talking to a computer. Now you see when you're talking, somewhere you're getting stuck. Okay, so now this should not be happening in an interview. Okay, so you must practice more because. Because in the interview, remember, there will be more pressure because right now you have less pressure because you're seeing me for so many months. But in the interview, you'll have more pressure, so you have to make sure you practice properly so that you don't get stuck in the interview. Okay, 1 minute. Okay, let's first test. Yes, Srishti, what is your answer? Let's test. 1 minute. Let's hold on to Srishti and Utsav. We may have to. Okay, let's see what first if Utsav is if Vipul is correct. Vipul is saying dollar yen position is short. Remember, position KRF market is taken as dollar yen, which means dollar as base currency. This is important. This will make a difference to how you assess the position because assessment of position has to be done with respect to spot markets, not the futures markets. So Vipul is saying dollar yen, if this market drops, which means it goes say from 105 to 97 or something like that, then Vipul is saying the position is short, right, Vipul? You said position is short.
Yes, sir. Yes, sir. Yes, sir.
So if you're right, then if the dollar yen exchange rate drops, which means the market drops. Market dropping means if you're short in this market means the market chart drops, you make money. The chart goes up, you lose money. So that means the prices, the number goes down. Let's check it. See if Vipul is correct.
Yes, sir.
109. Let's make it 105. Okay. What is happening to net worth? Net worth was 2.371. Okay. So Vipul is correct. Okay. Okay, so Srishti and Utsav will take your answers. I don't want to keep. So one of the. Okay, we're closing this. Okay, so in this case, we can see that Vipul is correct. So the position in dollar yen must be short because as we lower the exchange rate, the company. No, actually, what is happening? No, it's actually wrong, right? If you see what happened, what
Sir, it should be opposite.
yeah. So the net worth was
Reduced.
okay, 1 minute. The net worth was 2.37. Okay, what is happening? The net worth is 2.37, and you make it 105, and net worth goes to 2.2. So actually, net worth is going down. Okay, when the market drops, net worth is going down. Okay, so here, and if you do a Z here, now we'll come to the conceptual discussion of this in the next class. Okay. But the answer is actually not correct because it's actually, if you see now, we make this 115. See what happens to net worth. Okay, now you see net worth goes up, which means the first test is that it's behaving like a long position. Because if the price goes up, we are making money. If the price goes down, we are losing money. If we go back to control Z. Okay, so this is actually a long position. So we'll discuss it next. We have to also understand it conceptually. This is the mechanical way of doing it, which is not a bad thing, but we must also understand it conceptually, which is more abstract. Okay, so okay, you guys, the class is dismissed. I've taken 1 minute and 38 seconds extra. Okay, so your class is dismissed and everybody can leave. And those who have if anybody has a conceptual question, then we can discuss it, and then we will deal with administrative questions. Anybody has a conceptual question? We will discuss this matter. If it's related to this matter, we'll discuss it in the next session. Okay, I will explain to you how conceptually we should think about it. We saw already numerically that Vipul's answer was not correct. Okay. And we'll discuss the conceptual analysis in the next class. Yeah. Any other questions at this stage? Conceptual questions? No? Okay. So so Utsav and Srishti will have to raise their hands again in the next class when we start with the discussion of this question. Okay. All right, guys. So any other administrative? No conceptual, no administrative, nothing. Okay, so we can end the class here, right? Okay. Please do your readings. Please revise your concepts. Okay. Otherwise, don't leave it for the last minute. So I'm gonna close the recording then. Okay. Stop.